I see so many traders that fail every single day, and it's not just because of their strategy. It's because they can't stay disciplined long enough with one strategy for it to actually work out in the long term. Most traders are hopping around from strategy to strategy, thinking that the next shiny strategy is going to get them rich. When realistically, you want to stick to one system and one system only, repeat it every single day, and stay disciplined with it. Over time, that's how you're going to become profitable. And that's exactly what I do with my strategy. I trade breakouts and I repeat the same rules, the same system, and the same structure every single day. I day trade these breakouts and I swing trade these breakouts, and they make me an insane amount of money every single week and every month. I've been running the same system for years now. Same structure, same rules, same plan. I don't go against my rules, and if I do lose on the day and I see somebody else make a lot of money, I don't think their strategy is better. I focus on mine and I keep repeating my same systems, and that's what keeps me consistent in this market. So in this video, I'm going to be breaking down my strategy and exactly how I use it to make 6 figures every single year trading in the stock market. This is how you're going to finally stop overcomplicating your strategy, and you're going to be able to stick to one system and focus on that every single day. So let's get into it. All right, so let's get into how the breakout strategy actually works. The whole point of this system is to catch momentum early before a stock starts its next leg up. I'm not guessing, I'm waiting for price and volume to confirm. The first thing I look for on a stock is for it to be in an uptrend. That's the number one thing. If a stock is not uptrending and if it's not moving higher, I don't want to trade it. It has to be above the 200-day moving average. That tells me that we're in an overall uptrend. Then I also use the 10 and the 20 EMA as my short-term trend guide. When price is holding above those, it means that buyers are in control. Next, I want to see the consolidation pattern, something like a bull flag, a wedge, or a tight range. That's where most traders actually mess up or chase the stock too early. They chase it and they hope for it to rip, when realistically, if you just wait for the actual breakout, you're not anticipating a setup. You're taking the breakout and you're waiting for it to move. I wait for it to get tight. I wait for volume to dry up. And then for the breakout candle to confirm, that's my entry. Volume is the number one key to this trading strategy. You need to make sure that you see volume over your breakout level. If you don't see volume, there's no reason to take the stock. Then after you get the technical analysis down, it's all about risk management. I size based on the quality of the setup, not off of my emotions. I always know my stop loss before I enter, especially keeping my stop loss under the 10 and the 20 EMA. That helps me out a lot, because when you see the price move below the key moving averages, that shows you that the stock is not valid anymore and that you want to go to the next setup. And then when I am in a winning trade and the stock is actually breaking out, I'm usually looking to scale out at around 25 to 35% in profit to de-risk my position and to let my trade play out. And then the biggest thing at the end of the strategy when you are done trading is you have to journal. That is the number one thing that I believe that got me successful. Journaling my wins, journaling my losses, and understanding what I did right and what I did wrong and how I can do better for the next day. I go back to every single trade and I review my entries. I even review how I felt in the trade. I review why I wanted to take this setup and all of the above. Journaling, I promise you, is going to be the number one key to your success with trading. All right, now it's time to hop into the charts to work on our technical analysis so I can actually show you guys exactly what I'm looking for. You guys know that we were talking about how a stock needs to make a big move prior to the breakout. And this is exactly what you're going to look for. This is for a bull flag pattern. You're going to see the stock move up, and then you're going to see it make higher lows, lower highs, higher lows, lower highs. And this is what a bull flag looks like. This is the consolidation area right after that big move up. And what we're looking for after the consolidation is the breakout like this. Remember, our entry is right at breakout. Stop loss goes back into the range. And this is what we want to catch, the whole leg up after that consolidation. There's even setups like this, and these are one of my favorite setups. They're called the wedge pops. So you'll see a big move up maybe, or even a sideways stock, and then you'll see it pulling back, making lower lows, and then drying out in volume, slowing down. You can see it gets real tight, and then you see a pop on it. That's called a wedge pop. Those setups can play really well, and the risk to reward on the wedge pop setups are amazing. So here's a beautiful setup on the stock LUMN. You can see that this stock made a huge move up down here, right? So from these lows, you can see the stock made a huge move up. What does it do? It starts getting tight, breaks out, and then gets tight again, right? So if we just look at the scenario like this, look at this range right here. Look how tight it gets. You want to also draw your breakouts from the wicks, not the bodies. That's very important. I feel like a lot of people look at the bodies of the candles like this instead of the wicks, and you'll get faked out a lot of the time. So you can see how the stock made a big move up and then starts making higher lows, lower highs, higher lows, right? This is a clean base pattern, clean wedge. And you can see this is the day that we broke out right here. We absolutely ripped above our breakout level with a lot of volume right here. if you do see the volume over here, you see how we were declining, decline, and then boom, as soon as the breakout happens, we pop with volume above the average volume and we start breaking out. So now you see the pattern right here. You see what we're looking for in order to catch these swing trades. For your entries, you're going to go down to a 5-minute time frame. So let's scroll back all the way to breakout level to find our entry. So this is an actual tricky example right here. And I'm not just going to show you guys these perfect setups because trading is not perfect for one, and you're going to get caught up in these scenarios. So you can see the market opened and it absolutely ripped over our level right here. This is usually where our entry would be, right? You're going to either take it on the break or on a pullback, and your stop loss goes to low of day or below the moving averages, wherever your risk parameters are. Remember, that's the #1 key to trading: risk management. At the end of the day, who cares about this technical analysis? You should be focusing on your money management and how much you're willing to risk percentage-wise. So you can see if we had our stop loss back into the range, our stop loss would have never gotten hit, and you can see end of day, we actually ended up ripping. And then if we go to the next day, we ended up moving up overnight. We ripped this day. Went flat, mind you, we would still be swinging this, right? Because we're swing traders. We're usually picking, let's say, in between from a 1-week expiration to even a 1-month expiration. There's times where I pick 2-month contract expirations because I want to hold it for 2 months because, look, you can see the stock just kept ripping and ripping and ripping, and you want to make sure that you're catching this whole entire move when you are swing trading. Look at it on a 5-minute time frame. If you go to a daily time frame, look how that breakout looked. It's an insane parabolic move. You can see it broke out and just absolutely ripped. You can easily catch 500% on that. And that's the goal with these swing trades, guys. We're not just looking for 20 to 30% moves on our options contracts. These options contracts can go bizarre. I've traded breakouts and some of my trades go over 900%, 500%, 300%, and those gainers will be life-changing for you and your portfolio. So that's just one example of a tight base right here. If we do look at Tesla, let's go look at Tesla and look at this breakout. So you can see this is on a daily time frame, guys. By the way, we are looking at daily time frames when we are trading these breakouts. There's times where I day trade, and if I'm on a day trade, I'm going to be looking at a 30-minute time frame and a 1-hour time frame. But for swing trading in a bull market, you want to make sure that you're looking at the higher time frames. Remember, higher time frame, higher power, that's what's going to get you those big returns with your stocks. So you can see Tesla, huge base right here. Even if we go to the weekly time frame, you see how the stock just gets super tight right here. Not making a big move, just getting really tight on a weekly time frame, really tight on a daily time frame. And if we scroll down and if we look at the actual volume, see how volume was kind of declining right here? Just slowly just moving down, not a lot of volume. And then on this day right here, if we move our marker and look at it right here, see this volume right here? We picked up with a lot of volume and broke out of our level. So let's go to replay mode right here and check our entry on this. So you can see you're looking for a 5-minute candle closure over your entry, or you can take the pullback to the EMAs for a better risk to reward. But sometimes with these breakouts, they tend to rip and not come back. So you don't want to make sure that you're chasing stocks too high, and you want to make sure that you're getting a good entry. So you can see right here at market open, Tesla was still below that breakout level, right? You can see it was still in this range. This white line is our breakout level over this high right over here. You can see we have this prominent high that we rejected off of. Huge level for rejections over here at this level. So you can see the stock absolutely ripped above our level, pulled back and ripped again. That candle closure right there was showing me that we are above the breakout level. We're seeing a lot of volume. You can put your stop loss back into the range, and then we're targeting highs, right? If we go to the 30-minute time frame, just to scale up to show you, let's see what it did the next day. It absolutely ripped prior, that end of day. And then you can see, again, rips, and it just wouldn't stop going. I made 500% on this. I think it was almost 600% on this. Look how it gapped up all the way up here. So this is a beautiful swing trade, guys. And the best thing about swing trading is you don't need to be hands-on every 5 minutes. It's not like day trading where you're trading 0 DTEs or you have to be staring at the screen for the whole entire morning. Swing trading and trading breakouts gives you a lot more freedom than other trading strategies and other ways in the market, because most people have to sit on the computer and they'll day trade, or if they lose, they start revenge trading right away because they know that they can make their money back quick with 0 DTEs. With this strategy, it's a lot more hands-off, it's a lot more patience involved, and it's a lot less riskier. This is why I love the way that I trade, because I'm not putting crazy amounts of risk on the board every single day, and my positions move a little slower. They take longer to play out, yes, But that's the whole point. We don't want to be staring at screens every day and being full risk on. That's why most people lose in their trading. And that's exactly why I think that my strategy is one of the best, because like I said, it's hands off. You don't have to be staring at this screen every single second, and you let your positions ride and they make you money over time. That's why I love the stock market, because you're holding assets and these are building for you over time instead of just day trading every single day. And guys, there's nothing wrong with day trading at all. Day trading is fine. I still day trade some of these breakouts, but swing trading and trading shares for the long term is what's going to build you assets, and it's what's going to make you money over time. So you can see, just to give that example on Tesla, if we look at the daily time frame, look at that swing trade. It broke over this base and ripped 3 days in a row. Insane move. Like I said, I hit about 600% on that trade. It was a beautiful trade and it made me a lot of money, about over $20,000 in one trade. Here's another example on the breakout SoFi. You can see SoFi was pretty choppy right here, right? Building a base. If we put our line right here, you can see that I had this huge base right here, right? And then we did have the rising support. So I look at this as like a rising wedge. You see it's like a flat top right here, and then it's wedging up here. We want to see the breakout on this day. See how it broke out, gapped above that level, and then ripped. You're looking for the swing after that. So let's see the entry on this stock. So this is another hard example, right? You can see the market opened and it was kind of choppy and pulled back. Pulled back to the breakout level. You want to take these types of setups intraday. So you can see it pulled back and it started just ranging, right? You see it ranging, has a tighter wedge on the lower time frames, starts breaking out right here, and then that's where you're entering, right as it gets above the 10 and the 20 EMA, and then you're putting your stop loss at low of day, and you're letting it ride. Let's see if this trade ended up playing out. Some of them work, some of them don't work. Let's see if this would have gapped up overnight. Look at it right there. Gapped up overnight, beautiful swing trade. Let's see if it continues. Market opens right here. And look, that's a prime example of a swing trade not really working out. You can see at open right here, it opened higher, so you would have been up at open, but you see how it didn't follow through? This is a prime example of it not working out. And I'm not just going to show you guys win after win after win, because when you get into the market and you see a lot of false breakouts, it's going to hurt you mentally, and you're going to think your strategy doesn't work. And that's not the case. You just have to realize that stocks don't go up forever and ever. Always realize that when these false breakouts do happen and it does pull back like that, you want to keep your stop loss at break even automatically. Don't risk any more than you should be. Get out of the trade and move on to the next one. That is the number one problem I see with most traders. They overtrade, they revenge trade, and they hope that their stock just will continue to go and go and go. They never have a stop loss and they don't stick to their plan. I promise you, brother, once you start sticking to your plan, your trading will be exponentially better. So now you guys know what my strategy looks like. You know exactly how I'm entering. You know the technical analysis. Now I want to get into risk management with this for a small account. We're going to give an example of a $1,000 account and how much you should be risking, where you should put your stop loss at, and how you should be acting with these trades with a 1K account. Okay, so I want to give an example on Oklo right here. You can see Oklo had a nice falling wedge and broke out of this perfectly, right? You see a huge move prior on this move, pulls back to the key moving averages. You have 1, 2, 3, 4, 5 days of consolidation. And guys, what did I say we were looking for? A decrease in volume. You see how we were decreasing in volume before we actually broke out right here? See, when we break out, we start to break out on the volume indicator down here. It's very important to realize that. So you see this breakout. Now let's go to a 5-minute time frame, look at an entry, and show you guys how you would have exited and entered this trade and how you would have been with your risk management. So you see the breakout on a 5-minute time frame. I'm going to delete this because what I'm usually looking for is above the previous day high. So you see the previous day high with the breakout, you see it gaps over that, and it pulls back to that gap at market open. So this is another harder entry. I'm giving you guys these good examples, so when you do get into the field with breakouts, you're not just expecting a perfect break and just a continuation. There's going to be some times where it chops at your breakout level where it pulls back, and you want to make sure that you're getting a prime time entry. So you can see this is an example on a higher time frame what the breakout looks like. You see right here the wedge. Let's go back to the 5-minute time frame so you can get a closer look. So this is right before market opens, guys. Let's do this in replay mode, and you can see it gaps up above our level. Mind you, this is not when market opens. This is pre-market. So if you ever see a move above your level and it goes pretty high in the pre-market, you kind of want to stay away, or you want to wait for a pullback, because if a stock is already super overextended, remember, you don't want to chase a stock. You want to make sure you're getting in at breakout level and you're getting a good probable setup that has a good risk to reward. When you enter a setup that's too high, you're not getting a good risk to reward. If it pulls back, you're going to be in heavy drawdown when it's still above breakout level. So you don't want to get faked out, and you don't want to get these bad risk to reward setups. So if you see a gap up like that, you can see market opens, and we actually pulled back. So let's look at it right over here. Market's about to open. Bang, right there, the market open. You see how we pulled back to breakout level? The green line is our breakout level. We pulled back, we started coiling up midday, and this is where you want to draw your intraday wedge. You can see, even if we go to a 1 minute time frame in this situation, look how we started coiling up and drying out in volume. Mind you, you want to look for the breakout on the higher time frame, but if you see a wedge intraday on a lower time frame, like a 1 or a 5 minute, that's where you can get that prime time entry. So you see it coiled up right here, right on the moving averages, and then you see a burst of volume right there on a 1 minute, and if you go to the 5 minute, that's where we started breaking out of this as well. You could have entered right there, right as we got above the moving averages on a 5 minute time frame, and your stop loss goes to low of day or a break below the moving averages. Because realize, guys, if it is not holding above the moving averages like this, and if it's just going to break back below, you don't want to hold a stock that has no volume or no momentum over our level. It's very important to realize that either it breaks or it doesn't break. And that's why I love my strategy, because it's so simple, guys. It's either the stock breaks out or it doesn't break out. If it doesn't break out, make sure you stop out immediately and move on to the next trade. Like I said in the beginning of this video, most traders don't lose because their strategy sucks. They lose because they get emotional, they go on tilt, and they make wrong decisions that deplete their account. I'm sure you've been in that situation if you're a trader. If you're brand new, you don't want that to happen to you. Most traders just go on tilt and they end up blowing their account by making those dumb decisions. So you can see that would have been your entry, and look how high this stock went. You would have been up at least 100% in the first day. Insane breakout, and you would have made a ton of money. Now let's look if it ended up following through. So you can see the next day, look, it ended up going a little bit higher, and now it's consolidating a little bit, but there's going to be days where it doesn't just absolutely rip the next day and the next day. Sometimes it's going to wait a little bit. It's going to consolidate after the breakout, but remember, your break even is still all the way down here, so you want to hold the stock. Now look at how the stock ripped. Let's go to a 30-minute time frame. See how it consolidated that next day, and that might scare you out a little bit. You know what I mean? You're sitting in a stock, you're already up, let's say 100%, and it's just consolidating up here. You think that it's going to go back down. Realistically, that's where it shakes out all of the retail traders. You want to make sure that you're sitting in the market and in these breakout trades as they're holding the moving averages. Look at this on a 4-hour time frame. That next day after the breakout right here, it consolidated, pulled back, and then you can see the day after that, look how high this ripped. You would have been up at least 300 to 500%. So now that you know that Oklo breakout worked out, I'm going to show you guys how you're going to be managing your risk with a 1K account. So you see this would have been our entry out of the wedge pop right here, right above the moving averages. If you have a $1,000 account, you want to make sure that you're not risking over 3 to 5% max on the day on your account. There's people out there that full port these $1,000 accounts. They put $500 to $800 in per trade, and if you go on tilt and you lose a lot when you're heavy size like that, you can literally lose your account your first week of trading. So that's why it's very important to have good risk management and to size properly according to your account size. If you have a 1K account, I never recommend putting more than like $200 into a trade, because a normal stop loss for someone like me and someone like you with these breakout trades are usually going to be negative 20 to negative 25%. And negative 25% of $200, I'm pretty sure is $50. And $50 of $1,000 is 5%. That means you don't want to lose more than $50 per day if you are trading with a $1,000 account. As you start to compound your account, let's say it gets to $1,500 to $2,000, that's when you can start upping your size and upping your risk. But you don't want to be putting $300 to $500 in per trade, because if you put $500 into this trade and you lose 25% of that, dude, you're losing way more than 5% of your account. And if you go on a losing streak, your account will go from 1,000 to 0 quick as shit. That's going to be the end of this video though, guys. I hope you guys really enjoyed this educational video. If you want more videos like this, make sure to leave a comment, and leave a comment talking about your worst problem, and I'm going to respond to you in the comments. I hope all of you guys have a blessed week, and make sure to follow me on Instagram. Make sure to subscribe and join my free Discord link in the bio. I'll see y'all boys in the next one. Peace out.